AI stocks just had one of their ugliest weeks in months. Billions wiped out, headlines screaming AI bubble, and investors panic selling some of the strongest companies in the market. But here's the part no one's talking about. This sell-off isn't random, and it's not 2000 all over again. In fact, smart money is quietly buying right now. And in this video, I'll show you exactly why AI stocks crashed, what Wall Street is getting wrong, and the three AI stocks smart money is accumulating while fear is high. Your time is valuable. So let's get right into it. What triggered the crash? The spark came from earnings. Oracle reported results that shocked investors. Revenue missed, AI spending surged. Free cash flow collapsed to negative $10 billion in a single quarter. That instantly reignited fears of an AI spending bubble. The idea that companies are pouring tens of billions into AI infrastructure without clear near-term returns. Then came Broadcom. Despite beating expectations, Broadcom stock lost over $200 billion in market cap in one day after management warned that margins could dip as custom AI chips become a larger part of their business. And suddenly, the market snapped. AI stocks everywhere were sold aggressively. Meta, Microsoft, AMD, all dumped together. And that's where Wall Street made its mistake. The core mistake. Wall Street is making the market is treating every AI company like it's Oracle. Same story, same risk, same outcome. But that assumption is flat out wrong. Oracle's problem isn't AI demand. It's cash flow timing. Oracle is spending massive amounts upfront on AI infrastructure while monetization lags, forcing them to rely on debt to fund growth. But here's the key distinction most investors are missing. Not all AI companies are building first and hoping later. Some are already monetizing AI at scale today, and those companies are being sold off anyway. That disconnect is where opportunity lives. Why Broadcom was misunderstood. Let's clear something up quickly. Broadcom losing $200 billion in market cap wasn't because AI demand is slowing. It's because investors misunderstood custom AI chips. Broadcom has been designing custom AI accelerators for years, for Google, Meta, ByteDance, and now OpenAI. And yes, management said revenue from OpenAI won't be meaningful in 2026. That's not a red flag. That's how advanced semiconductors work. Design, fabrication, testing, optimization all take time. Meanwhile, Broadcom just disclosed a $73 billion AI backlog over the next 18 months. That's demand, real demand, locked-in demand. So if Broadcom is being mispriced, what about everyone else? That's where our three stocks come in. Stock number one, AMD. Let's start with AMD. AMD stock is down roughly 15% in the past month, and investors are nervous. Why? Competition. NVIDIA dominates headlines. Google is selling its TPUs externally, and AMD trades at a high price-to-earnings ratio. But here's why that fear is misplaced. First, PE ratios are terrible valuation tools for hyper-growth companies. AMD is expected to more than double earnings next year. Second, AMD's data center business is growing at around 80% annually, driven by massive demand for AI accelerators. Their deal with OpenAI alone could deploy up to 6 gigawatts of Instinct GPUs, representing potentially over $100 billion in long-term data center revenue. But here's the overlooked advantage. AMD is not purely an AI stock. About 43% of revenue comes from client and gaming, CPUs, GPUs, and semi-custom chips for consoles. And that segment grew 73% year over year last quarter. So while investors are panic selling AI exposure, AMD actually benefits from diversification during AI downturns. DCF models estimate AMD's fair value near $380, while it trades around $210. That's not hype, that's math. Stock number two, Meta Platforms. Next up, Meta. Meta stock is down mainly for one reason, AI spending fear. Management guided 2025 capex up to $70 billion, with even higher spending expected in 2026. And investors remember 2022. They remember the metaverse, They remember margins getting crushed. But here's the critical difference. Meta is already monetizing AI right now. Over $60 billion annually in ad revenue is driven by AI optimized targeting, recommendation engines, and automation. Every time Meta improves who sees what ad and when, conversion rates rise. That means higher ad prices. That's AI monetization. And now Meta is layering AI assistants across Facebook, Instagram, WhatsApp, Messenger, and hardware. That's billions of daily users feeding real-time data back into ad systems. Oracle hopes to monetize AI someday. Meta already does. DCF models show Meta is about 23% undervalued, with roughly 30% upside from current levels on one of the most profitable companies on earth. Stocks over 3, Microsoft. Finally, Microsoft. Microsoft plans to invest roughly $80 billion in AI infrastructure in 2025 and even more in 2026. That number scares investors. Power costs, data centers, model training expenses. But here's what the market ignores. Microsoft is monetizing AI across existing products. Azure AI workloads are accelerating. Copilot adoption inside Microsoft 365 is rising. Enterprise pricing power is increasing. AI isn't a standalone bet for Microsoft. It's a multiplier across Office Teams, GitHub, LinkedIn, Azure SQL, Visual Studio, and Microsoft's earnings already reflect this. Despite rising capex, profits are growing. DCF models place Microsoft's fair value around $600 per share versus roughly $480 today. That's a 25% upside on one of the most diversified businesses in history. Why this sell-off is actually healthy. Here's the big picture. This isn't an AI collapse, it's a rotation. Capital is leaving companies with weak cash flow visibility and piling into companies with diversified revenue, proven monetization, strong balance sheets. Wall Street is throwing everything into the same bucket. And that's when long-term investors get paid. What smart money does differently. Smart money doesn't buy headlines. It buys mispricing. When fear rises, valuations compress, expectations reset, long-term returns improve. AMD, Meta, Microsoft. Different businesses, different models, same mistake by the market. And that's exactly why they're being accumulated quietly right now. My final thoughts. So now you know why AI stocks crashed, why Wall Street is wrong, and the three companies smart money is buying while fear is high. If you want to see what else I'm buying to get rich without getting lucky, click the video on screen. And remember, the best investment you can make is in yourself. I'll see you in the next one.